Welcome. This is part 3 on the farm balance sheet. Um, this section, we're going to talk about depreciation and what it is and how to do it for straight line and declining balance. What depreciation is this annual loss in value of working assets due to their use, their wear and tear, their aging, and just technical obsolescence that become out of date. So, which ones do you actually depreciate over time? It's anything with a useful life more than 1 year. Sometimes it has to have a useful life that can be determined. It can't be one that's unlimited land. You don't depreciate land, really, is what it is. And so, machinery, equipment, buildings, fences, breeding livestock, perennial crops, irrigation wells, land improvements, things like wells and tile drainage, all those are depreciated. But land itself is not depreciated because it has an unlimited life. So, what it really, there's three main reasons why farmers detract depreciation. One is for taxes. If you can claim $10,000 loss in value for an asset, that $10,000 is a cost of doing business. You subtract that from any income you earned during that year. So if you have $100,000 worth of income after you take all the things you sell, subtract all your costs of business, if you have $100,000, that's what you would start to, it shows up in your tax forms. We'll cover that later in the course. But if you can add, oh, I've got $10,000 worth of depreciation, now it's only $90,000. You deduct depreciation as a cost of doing business, and so it reduces your taxes, the income you pay taxes on. The other one, you might want to track the true value or the farm book value. So you have a tax depreciation, but it actually might be different than the value of the asset. And it's particularly for market basis balance sheets. You might have machinery that's declining in value at a certain rate for tax purposes, but then there's a real rate of decline that you think is more accurate. That's what you would capture with your market basis balance sheet. So you want to have that value, say, for your collateral and loans and such like that, or just to have your market basis balance sheet. And then the last one is sometimes people are concerned about the insurance purposes. Some insurance policies only insure an asset for its replacement cost, some insure it for its replacement cost. Some do it for the actual value of the asset. A simple example, and this applies to everyone, like homeowners here in urban areas or suburban areas, you might have the insurance might be low because what they actually do is they depreciate the roof. And so you have a new roof, you put it on your building, it's there, it's got a life of 10 years. Well, after 5 years, it's lost half its value. And so they don't insure the cost of putting a new roof on your house, they insure the cost of the value of the roof. And so, well, it cost you $3,000 to put it on, but it's been out there for 5 years. It's only worth $1,000 now. And so the insurance is, they only insure that $1,000 in value, not the cost of putting a new roof on. Farm assets work the same way. And you might want to keep track of that differences. So, if you're insuring it, how much do I need to replace it? Or if you're doing the valuation of insurance, how much is it actually worth? So these are the main ways farmers might be concerned about depreciation. Most of them definitely for taxes, and then maybe the true value for their market basis balance sheet. So there's sort of these main definitions, and to capture this intuition, essentially you've got three things. You got a cost, a useful life, and a salvage value. The cost is what you paid for it, and the salvage value is what it's going to be worth when you get rid of it or at the end of its useful life. And then that useful life is a certain number of years or a period of time between that you're using it for. And so you've got an initial purchase price, say $100,000. It lasts for 5 years. At the end of that 5 years, it's only going to be worth $20,000. So there's $80,000 of value, and you're going to allocate that $80,000 decline in value over those several years. That's what you're trying to do. Allocate the initial cost of a long-term asset. I should say really initial cost minus the salvage value of a long-term asset across the useful life that you're going to give it. And so really the key point in all these, though, is all these depreciation formulas make assumptions and are estimating this annual loss in value. None of them is correct for all assets in all situations. So here's the graphics of it all. You got these 3 points. Here's the initial cost. Here's the salvage value. And here's the useful life across here. And so you're going to go from this point here down to this point here. And you got that total loss, that total decline in value, that red mark. That's what you have to allocate across this useful life. How do you go from this dot to this dot? Do you drop off quickly? Do you go in a straight line? Do you go flat and then you come off quickly, drop off at the end? There's all kinds of ways of doing this. We're going to talk about the two primary main ones are going to be straight line, which is just go from A to B in a straight line. And that line, that loss, so like this is year 1 year, this is maybe year 3, year 4, in that year, you go from here to here, that loss in value right there, that's your depreciation. Delta T, and this is 1 year, that decline in value over that asset, delta V. Depreciation is a change in value per unit time, delta value over delta T. And that's all you're trying to do here. And there's different ways from going A to B. We're going to look at two primary ways. Our straight line, like illustrated here, there's a declining balance, which gives it a curve. And the curve can be sharper or flatter. The rate of the curvature is stronger, different with a change of a parameter, what percent of declining balance. But those are the two primary methods. Straight line depreciation, I mentioned it already. It just draws a straight line at the beginning and end values, and gives you a constant depreciation each year. A certain number of dollars each year comes off the value of the asset. So how do you calculate it? It's initial cost minus salvage value divided by the useful life. It's very straightforward. And there's another way to report it we'll get to this, the use of the tax tables is a rate and as a percentage. And what you do here is what's the percentage? It's 1 over the useful life. The straight line depreciation rate, R sub SL. It's just 1 over the useful life, that's a rate. So say it's a 10-year asset, 1 over 10 is 0.1 or 10%. What that means is each year you lose 10% of the total value due to depreciation of the cost minus the salvage value. That amount, each year you lose 10% of it. That's what the annual depreciation is. It's just another way to do it, and that's how the tax tables do it, is as a percentage. So here's a simple example. You got $100,000 piece of equipment, you use it for 6 years, expected salvage value is $40,000. Well, $10,000 minus $40,000 is $60,000. Use it for 6 years. You can see $100,000 minus 40 divided by 6, you can get $10,000 a year. The other way to do it is 1 over 6 is 0.166666 or 167 or 16.7%. So what's annual depreciation? 100 minus 40 times 16.7% is $10,020 a year. So you can see that one's very simple. Just draw a straight line, calculate the annual depreciation, or do it as a percentage. So here's an example. You started out $100,000, take $10,000 depreciation. At the end, it's $90,000. This 90 shows up as the beginning value at the beginning of the year again, and you do another 10,000. And you see it just goes click, 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 down 10,000 a year. Depreciation is always the same. It's fixed. And then these always come back and forth. The 90 from here goes over here to 90 at the beginning. The 80 at the end becomes the 80 at the beginning of the year, and et cetera. And you draw a line. It goes from 100,000 down to 40,000 in a straight line over those 6 years. So that's another example here, just to make sure it's completely obvious. This one is fairly straightforward. $100,000 piece of equipment, you're going to completely depreciate it, 0 salvage value. 5 years, well, you can see it's $20,000 a year. 100,000 minus 0 divided by 5 is 20,000 per year, or it's a 20% depreciation rate. Each year, you take 20% of the value of that initial $100,000 minus the salvage value. So it's in this case, it's just the purchase price times 20,000 or 20% each year. So that's straight line. You can lay this another example, just extremely obvious how to do this one. This one's a very straightforward way of doing depreciation. Have a little think break. Normally in the classroom, you'd pause, do this problem. You can expect one of these as a problem set and an exam. So $70,000 piece of equipment, use it for 3 years, and it has a salvage value of 10. So you should be able to figure out how much depreciation you're going to take per year. What is a straight line depreciation for the second year? Pause to work that out, and I'll go to the answer here in a sec. So you can see it's just going to be cost minus salvage value divided by useful life. 70 minus 10,000 is 60,000 divided by 3 is $20,000. So 70 minus 20 is 50,000. 50 minus 20 is 30. 30 minus 20 is 10. And so the second year, it'll be $20,000, just like it is in all the other years. Okay, declining balance is the other method. And what this one does is it's a constant percentage of the asset's current basis, not the salvage or purchase price minus the salvage value, not a percentage of that, but of the current value, or what they call current basis. And so it's a constant percentage, and so it's the current basis times the R sub dB for declining balance. So the current basis times the rate, the declining balance depreciation rate. And the key is because the balance, the current basis, declines in value as the asset is depreciated, the actual dollar amount of depreciation comes down each year. You're taking a same percent of a smaller and smaller number each year. And so it's a constant percentage rate, but it's the declining balance, the declining basis each year reduces the dollar amount of the actual depreciation. And usually what we do is the declining balance is done as a multiplier of the straight line depreciation rate. So R sub SL, 1 over the useful life, is the straight line rate. What the declining balance uses, usually there's double declining balance, 1.75, 175%, 150%, 125% of declining balance. Use that multiplier times that straight line rate. So if the straight line rate is 10%, double declining balance is point R sub dB is 20%, 2 times the useful life, the straight line rate. And so you get numbers like that. You'll hear double declining balance or 150% declining balance. This is actually commonly used in taxes, and so that's why we're covering it. And I'll go through some examples here, and then we'll get to the tax versions of this. So here's doing an example of double declining balance. You have a $100,000 piece of machinery, use it for 6 years, the expected salvage value of $40,000. We've done this one already. The straight line rate is 1/6 or 16.66666, or what you hear 16.67%. So what's the double declining balance? It would be twice that rate, or 2/6, or 2 times 16.67%, or we'll use 33 1/3%, or 0.3%. So during a year, the asset loses 33.3% of its initial value in the year. So the first year, what is it? You bought it for $100,000. That's its current value. Take it times 1/3 or 33.3%. You're going to get $33,333. That's your double declining balance. So next year, you get this 33. So your ending basis is 66,667. That becomes the beginning basis for the next year. You take the 33% times that number, and now you get 222 or 22,222. So 66,667 minus 2222 is 4,444. So you end up with a current basis at the end of the year of $44,444. That starts out the next year. You take 33% times that. You take $14,815. That gives you this value, which is $44,444, minus this depreciation gets you this number. And you can see this percent here, the 33% is the same every period, but the value it's multiplied by declines each year because you take the $100,000 minus, and you get down to 66. That comes over here, 33% of that, 33% of 44, 33% of 29, etc. And you work your way down, and you'll notice the actual dollar amount of depreciation starts out large and then quickly falls off. A couple problems you might have noticed. I go back to the problem here. It says it has a salvage value of $40,000. Well, we go below the salvage value here. We have $44,444. The formula says take $14,000 worth of depreciation, and so the actual value of the asset would fall below the salvage value. Well, basically, that's a problem with these declining balance methods, is that the basis of the asset can be below the salvage value. That's a problem. You have to have a fix for it. So assets with positive salvage value, the basis can fall below the salvage value. So what they do is you stop depreciation at the salvage value, or you switch over to straight line depreciation along the way, which is what happens in taxes. Assets with zero salvage value, you're never going to get to the salvage value. It comes down and asymptotically approaches zero, and it'll get down there to, after a certain amount of time, it'll get down to pennies, but it never quite gets there, asymptotically approaches it. So the solution to both of these is to do some sort of a correction, either just take the remaining value and get to the salvage value, or you switch over to straight line somewhere along the way. So you come down quickly and then go to straight line depreciation for the rest of the asset life. So we'll do some examples here. Here's the salvage value was $40,000. Well, what that means, when you get to this $44,444 as the initial value, instead of taking that $14,850 worth of depreciation, you take it only to $4,444. So you're at the $40,000 salvage value. The rest of the life, you take no depreciation because you're at the salvage value. It's kind of an ad hoc fix. And so here's what you were wanting to do was this line. That's what your straight line, your 200% declining balance would have done, is come down like that and taken these other values, but it goes below the salvage value. So at this point here, instead of going down to here, you actually take this line, hit the $40,000, and you have a value at $40,000. You take no more depreciation. So what you'll see here, I'm going to compare the two methods quickly. There's two of them. The straight line depreciation is the slowest, but it's easiest to use. It finishes right at the salvage value without any adjustments. Declining balance really it rapidly depreciates the asset much more quickly than straight line, which better matches a lot of assets out there. But it requires some sort of adjustments to finish at the salvage value. It just doesn't work at that on the salvage value. It goes below it if it's a positive salvage value, or it never gets there if you have a zero salvage value. So you got to make some sort of adjustments. But a lot of assets do have a rapid decline at the beginning. Some of you probably heard the story. You buy a new car and you drive it off the lot, it's already lost a few $1,000s in value because a new car is worth more than a car that's, even if it's only hours old, it loses value. And a lot of assets have a rapid depreciation at the beginning that then slows down. And that's what declining balance is trying to capture, is that rapid depreciation initially. So here's an example here of these two assets we just did, that same asset we did with two methods. This is the amount of depreciation per year. That straight line was a constant value each year. The declining balance, we took a 33,000 some the first year, and then it fell down real quickly, and then went to zero. So you can see the amount of depreciation declaimed on taxes or for tracking the value of the asset. It's huge in the double declining balance, and then it quickly falls off to nothing, whereas straight line, it's constant all the way across there. And here's the asset values. The blue is the straight line depreciation. It just each year goes down $20,000, whereas the other one quickly falls off rapidly and then gets flat and gets there. With the last few years, there's no change. It's just flat, no depreciation. And so which way do you want? Which one better matches the actual decline in value of the asset? That's what the straight line versus double declining balance gives you. So what we'll do here is another think break. I'll lay it out, and here I would recommend pausing, working through it, and then I'll go through the answers here. So you got some simple machine, cost $7,000 with a useful life of 3 years and a salvage value of $1,000. So let's do the double declining balance depreciation during the first year. What is it? What is the basis at the end of the first year? What is the double declining balance depreciation during the second year? What is the basis at the end of the second year? So work that one through, and I'll go through it here. So our useful life is 3 years. So 1/3 is the straight line rate. So double declining balance is 2/3, or we'll use 66.67%. So you do $7,000 times 2/3, or 0.66666. So you end up with $4,667 of depreciation. So what's the basis at the end of the first year? 70,000 minus the 46,667 is $2,333. Second year, what's the depreciation? It would be $2,333 times 2/3, or $1,555. So the ending basis would then be $233 minus $1,555, or $788. That's declining balance. However, you can't take all that $1,555 in year 2, since it implies going below the salvage value, which I gave as $1,000. And so what you do then is you can set the second year of depreciation so that it fully hits that $1,000. So $233 minus $1,333 is $1,000. So you would only claim $1,333 in depreciation. And then the ending basis at the end of year 2 would be $1,000. That's the one way to do it, because if you follow the formula, you would actually take the asset down to $788 below its salvage value. And so to prevent that, instead of taking all of the second year's declining balance depreciation, you only take it until it hits the salvage value.